So you might hear people complain that they lost money in the stock market. Why do people lose money in investments? Really, I see the big one as being emotional. So if you sell when you see stuff go down, that's the exact opposite time you want to sell. You want to be buying more in general. So the other one is short time horizons. If you need the money in the next 5 years, it should not be in the stock market. If you're looking to buy a house or something with that money, it should either be, if it's, I would say in the next 12 months, that money should be kept in a high yield savings account. If it's maybe 1 year to 5 years, a high yield CD will probably give you a little bit better interest. If people have it in the stock market and all of a sudden they see a downturn and they know they need that money, guess what? They're going to sell it when it goes down and will not reap the rewards when it goes back up. The other one is, I see a lot of people go, oh, I got this really great stock. I'm going to buy all of this stock and invest too much in this one thing. By the time you see something on TV, it's already too late. Anybody that had smart money or was already in, and now you're going to be basically buying it off of them at a premium. What you'll see with a hot stock tip is generally you'll see it go up real quick, and that's about the time when TV or somebody says, hey, look at this great stock, and then what happens is it usually does this. And then those people get burned and lose half the money they put in, because then as soon as they see it go down, they need the money, so then they sell because they're emotional, and it's in one stock. It's not in a diversified portfolio or anything. The other big one I see is a lot of people try to get rich quick. They don't like to invest for a long period of time. They want to get in, get out, and then they wonder why they lose money. So a combination of all these four, that's the major thing of why I see people lose, tens of thousands, if not more, in the stock market. How do people build wealth in the stock market? Well, people that invest consistently over a long period of time, at least 10 years or more, generally you'll see some downturns in a 10-year period, but then it'll climb higher if you're looking at, like, say, the S&P 500. Past performance does not dictate future performance. Just be aware of that. All investments can lose value, but on average, the S&P 500 has returned 10.7% per year on average over the last 30 years. We want to take emotions out of this. We don't want to say, is it today a good time to buy? Is tomorrow a good time to buy? We don't really want to think about it. So there's something called dollar cost averaging. I have a video on that as well. Basically, you're going to buy the same amount of money in stocks every single month. Every time you get paid, you'll buy the same amount. That's going to remove your emotions. You're not going to worry if it's high or it's low. It's fine. You're just going to keep buying. 3, you're going to invest in very boring, proven companies, such as something in the index, like the S&P 500. You're not going to buy a single stock. You're going to buy hundreds of stocks within either an ETF, a mutual fund, or something along those lines, and you're just going to buy and hold it. All of this is very boring, I understand, but this is how people get rich. They don't get rich within a year. They don't get rich overnight, and if you do see that, it's because it's not normal. They're the very lucky few, and generally they don't get lucky more than once. The majority of millionaires in the United States today have a paid-for house, and they have a 401k that they've funded for many years. They didn't become multimillionaires when they were 20. They became millionaires in their late 40s. And if they stay invested in the S&P 500 or something like that, with a 10.7% annualized rate of return over the last 30 years, what you'll see is that they'll have another $1 million in the next 5 to 7 years. And then 5 to 7 years after that, they'll have an additional 2 more million. And once they get to that point, the net worth basically just explodes. But again, they invested consistently over a long period of time, probably 20 years at that point. The dollar cost average, put it in a 401k, so every paycheck they put it in. They also invested in very boring, proven companies. So companies in the S&P include something like, you have Apple, Facebook, Ford, General Motors, you have Visa, MasterCard, Coke, Pepsi, Home Depot, Lowe's, all kinds of different companies. There's 500 companies. Anything that you buy is probably there. Procter & Gamble, you also have Kimberly-Clark, Smuckers, that sort of type of thing. You're going to have a pretty broad range of companies that are in there, so you're not in any one sector. I understand that there's a lot of the S&P 500 that's currently towards, technology. But overall, everything that we do today relies on technology. I'm not overly worried about that, but that is one thing to look at. It's about 25-30% technology, so it's a little heavy in that. But it does cover all the other areas of the economy. So thank you for watching. If you want to learn how to make more money, how to save, and how to invest, subscribe.